Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on. If you want to follow me at _finance, and if you want to join our community, finding-value.com, use special as the coupon code if you'd like to join. You get a discount on both the monthly and yearly memberships. You can ask me questions. You can join our Discord, become a part of the community. We help each other out through these pullbacks, if we get pullbacks or sharp corrections. I share what I'm buying, the chart setups, and if you guys really like looking for companies, if you like uh, looking for setups out in the market, then yeah, this will be a great thing to either learn if you haven't learned it yet, or to be a part of the community and just hang out with people who are like-minded. So definitely try it out if you have any interest. So Logan says, we have a new rule. If you ever tweet at me that investors own most of the homes in America, you will be blocked because you can't read like a 5-year-old. I've seen this a lot. Um, not that people are, not about him getting mad, but if you know the data and you can read, if you can, if you have an analytical mind and you read data quite well, there are so many people that can't read data and interpret the data. And I would say, at a minimum, to look at some of these charts, you might need 100 to 110 IQ maybe to make good use of them and have the correct analytical skills to boil down the essence of like uptrend, downtrend, looking at percentages and maybe thinking, you know what, the way that this is presented isn't a very good way to present material. A lot of people come off as experts. I will name one, Reventure Consulting, and I don't think he can read charts. Like, I really don't. The way that he presents charts are either he doesn't know how to read it, or he is purposefully feeding information to get an outcome that he wants. For example, when you look at inventory levels, you want to look at the total inventory compared to history. If you put it in percentage terms and your inventories were at extreme lows, like 2 months of inventory or 3 months of inventory, if you have a 3 month increase of inventory, that's 100% increase of inventory levels. And then you look at history and say, oh my God, we've never had a 100% increase of inventory levels. And it's kind of like, well, dude, you were at 3 months. We've never been at 3 months in history. So how could you have an increase of 100% if you really never had the inventory levels down that low? So it's very, when you show data like that, it can be very misdirected, or it's not the true showing of what it is. Because a lot of people say, oh my God, inventory is up 100%. Yeah, it's at 6 months. 6 months is like nothing when you look at history. Meanwhile, so this is Tavi. He says U.S. money supply just reached all-time highs again. It's not about the money supply; it's about the rate of change. So the rate of change, that's really what I look at for the money supply. That rate of change is what causes inflation. So inflation is a measurement of rate of change. It's not a measurement of all-time highs or volume necessarily. I mean, volume is rate of change to some degree, but it's not the absolute measuring stick. It's the rate of change, and that rate of change is the inflation rate, so to speak. So increased money supply is inflation. Gold accounted for this movement probably before it even occurred. It front runs this. And then when this money starts working its way through the system, it takes about 12 to 24 months. So if this occurred in late of 2023, we might be seeing the inflation coming here now, pretty soon. And then it'll feed its way through a lot of the markets. So you'll see it feeding its way through fertilizers and some of these inflation sensitive assets first. Oil is last. Coming down, Calvin. And again, this is just human nature. This is the herd. It's the same literally every time. Cyclical company sells off from a frothy heights. It sells off 50, 70, 90% drawdown. People don't call buying at 20-year lows astute. They say stuff like catching a falling knife, say the market is always right, and insist it's in a terminal decline. Well, that's where you have to buy. You have to buy in the pullbacks somewhere between 50, 60, 70, 80%. That's how you make money. But people, the sentiment is what keeps everyone from buying. They haven't changed their mindset. To be a successful investor, you need to do different than everyone else. But it's the same crap. I see it too. It's hard to retrain your brain. It takes a little bit. It takes someone to show you how to do it. And then once you start to see it, and then once you gain confidence in the strategy, that's when you change. You're like, oh, that's how you do it. Then you look at the entire world differently than what you looked at before. And there are some things that you have to do. It doesn't work. You won't catch every single bottom perfectly, but it's the percentage that you catch at close to bottoms that makes it worthwhile. And then it's the returns that you get. So no strategy is perfect, but it's the one that yields the best returns that someone should try to adopt. At least that's my viewpoint. My strategy is basically buying on these big drawdowns. I don't chase the frothy heights. I don't go and chase something. I wait for it to pull back. I look for generally a falling wedge of some sort. I look for a bottoming pattern. There are, inverted shoulder head shoulders, double bottoms. There's all these different things. And what you're doing is if you buy down there, you're reducing your downside risk and you're maximizing your upside potential. And you're using technical analysis in your favor to do that. And obviously, you want to buy fundamentally strong companies coming into fundamentally strong sectors that are turning in favor. Novelism says people who live far below their means enjoy a freedom that people busy upgrading their lifestyles can't fathom. I never, and maybe it was the way I was brought up. I don't really know. My parents, they live, they live a really good life. And I think they're just content with what they have. And I would say I'm not exactly the same, but I'm very similar. Uh, and maybe I'm just kind of personality wise different, but I don't require a lot of crap. I don't need it. The most important thing is food, eating very healthy and staying healthy. That is the number one thing. And when you're young, everyone measures their success by materialistic crap, which just doesn't matter. And then when people get old, they measure that differently. They measure it through your health. Now, what if you're young and you kind of got the cheat sheet of what you can do over your lifespan? The cheat sheet is eat healthy, get strong, be smart, and live the best life that you can in great health. That's it. That's the cheat sheet. Driving a Toyota versus driving a Lexus versus driving a Lamborghini, they do the same crap, guys. One, you just pay a lot more for, you pay a lot more insurance, a lot more registration. And in all honesty, you're probably going to have just as much fun in most cars. There's nothing more fun than going out there in a car that's less capable and beating more capable cars because you're a better driver. There's nothing better than that. It's always fun to drive the underdog. And it's always fun to drive, I'll call it, you've got like an analog type car. It's so fun. Driving it on the limit, feeling it. kind of four-wheel drift and slide. And then if you just tap the brake, you can get the rear of the car to come kind of tighten and come around on a corner. It's so fun. Paging John Murphy. So we've got John Murphy. I don't know who John Murphy is, but we got copper breaking out on the upper one. We've got 30-year yields about to break out to the upside, which I share all the time. And notice that the 30-year yields looks very similar to gold. Gold's been in a consolidation too. And I don't know if this is on the same time frame though. We've got commodities that are basically ready to rip higher. You can see we're at resistance. We've got higher lows coming off the bottom, ready to break to the upside. And then we have agricultural commodities on the bottom that's basically been ripping up in an up cycle, looking pretty solid there. So this is kind of just a snapshot across four different sectors that are commodity related and yields. Notice anything similar there? Anything similar? Now, this is kind of how I look at things. You know, I look at the big picture. The big picture breaks. These are pretty long time frames. Like this one's back in 2021. It's a pretty long time frame. It's not super long, but it's decently long. And if you break through this, they're not just breaking this time frame. You're breaking the whole 20-year time frame, going back to 2020, 2027, 8, that top. So these all look fantastic to continue higher. Walter Bloomberg says nearly 90% of economists, 89 out of 100 to be exact, say they are concerned about the quality of official U.S. economic data, including 41 saying they are very concerned about the quality of the official U.S. economic data. I am also concerned that the data is made up. Now, how can we use this data to draw correct conclusions if the data isn't correct? That's exactly right. So we got to go with the charts. That's about the only thing that we can see is positioning in the market. And some of this data here, it is, yeah, we'll see what it looks, we'll see. Joseph Brown says, and this is just an opinion, he says, every financial decision I've made solely for the purpose of saving money on taxes has been a bad decision. Each time has resulted in less total net worth than if I had simply done nothing, let alone had I instead actually just tried making more money. The key word here is solely. Focusing exclusively on taxes for financial decisions is putting the cart before the horse. The primary focus should be on maximizing wealth. Taxes absolutely need to be considered, but not primarily and definitely not exclusively. So taxes, yes, they suck. And once you start making more and more money, you shouldn't focus exclusively on trying to reduce taxes. There might be better ways to grow your wealth versus then spending all your efforts on trying to keep what you have already made. U.S. margin debt exceeded 1 trillion for the first time in history in June. Look at that chart. Going vertical, baby. Lots of borrowing. Another one from Joseph Brown. He says there is a growing movement of people just canceling their health insurance and using DPC doctors. DPC is the direct primary care, are doctors that don't accept insurance. They tell you how much something will cost and you just pay it. They are often cheaper than the typical model of insurance plus copay bills. Even traditional doctors will have a cash pay, no insurance option that is often cheaper than using insurance. For emergencies, people will invest the same amount they are paying on their premiums, essentially becoming self-insured over time. For large catastrophic expenses like a car accident or cancer, they are rolling the dice and planning on just negotiating a payment plan with the hospital if necessary. I don't know if this is great or not. I would love to not have health insurance and just pay directly if I could do that. and it probably would be cheaper for the majority of things that do come up. It is a problem if you have something catastrophic like a heart surgery or something like that, a triple bypass, whatever it is. But for most things, if you're pretty healthy and you're pretty smart and you're avoiding a lot of the high risk things, you probably could do quite well using this direct primary care. And I don't know much about it, but it does look pretty interesting. And here it says Americans now spend more on healthcare than groceries or housing, with healthcare accounting for approximately 20% of household expenditures. If you're investing in the miners, I urge you to read this. Save yourself the pain and learn this all. It will change your life. Okay, let's read this together then. So this is when to sell a winner. So that you want to make buy decisions using fundamentals and technicals and make sell decisions using technicals alone. That's what I do. That's my approach. Climax top. A climax top occurs after a huge price move over many months after the stock is extended out of its last base. 8 out of 10 of the best topped this way. Look for these signals, 25 to 50% in 3 weeks or less. The largest daily price run up since the beginning of the whole move up. Exhaustion gaps, extended over 100% above the 200-day moving average. A recent stock split. 7 out of 8 days are up. Largest weekly price spread. Railroad tracks and island tops. It's a technical pattern. Sign of weakness, heavy daily volume without further upside price progression. This is sign of distribution. So big volume, but the price doesn't move up. New high on low volume, poor rally in light volume, lagging relative strength, third, fourth, or fifth stage base, faulty base structure, 2 weeks down, then 2 weeks up. So third, fourth, or fifth stage base, that's your Elliott wave. And everything else is based off of you're looking for volume, but no price follow through for the most part. Change of trend. Stocks continue to trade below the 50-day, the largest one-day price drop, and an uptrend broken. So that's some stuff that you can look for on when to sell a big winner. Money wisdom. To me, saving was as natural as breathing. I knew when I saved $10, I was really saving 100 or 1,000 because of the future growth, and that's basically what I do. I mean, that's literally what my mindset. It was always that from the beginning. But another thing that drove me was I didn't like my 9 to 5. So I mean that's like, how do I get out of this thing? So then I figured that I would save my way and invest my way out of work is really what a big driver was as well. So it was knowing that I could save money for my future self. So my future, I was trying to lock in future happiness for myself by not having to work a 9 to 5. Crude inventory falls below the 5-year range for this time of year. There we are. Look how low that is, below the cloud almost. We've been playing at the low end of this cloud quite frequently here. Eric Nettles says U.S. oil rig count down 7 to 415, the lowest level since September of 2021, and 25 rigs below maintenance level. 260,000 barrels per day of annualized production declines is what we are expecting with this rig count. The energy market is not ready for the twilight of U.S. shale, in his opinion. This is going to get interesting with time. Investment wisdom here says, what's influenced your investing mindset the most? Trial and error, academic education, a book or author, conversations with peers. I would say mine is trial and error. That's what the check mark is. So I voted there. Trial and error. And then I would say a book or author. Yeah, I've read some books and I don't think they were super influential. They reinstated what I learned through trial and error. So I think you need to go out, trial and error, and then read a book, and then come back years later and read the same book, and it'll feel like you're not even reading the same thing because you've learned and you've tried to apply things in the market where, oh, that's what he means by that. Oh, that's the approach that he was trying to get through. Yeah, that's kind of my view on it. Psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. Understand the importance of resisting those swings. Profit, if you can, by being counter cyclical and contrarian. What did I read the first one above there, right? They were talking about people not being able to buy when something sells off 30, 40, 50, 60, 70%. Well, that's the psychological swings. That's your big pullbacks in a big fundamental bull market. That's when you want to buy. To understand the importance of resisting those swings, profit if you can by being counter-cyclical. Cyclical is short-term. Secular is long-term. And cyclical lasts like a year or two. Ignore gold. Silver and gold miners show relative strength. This is our signal. Shakeouts precede breakouts. Keep that in mind. Another one from RBE says silver is on a fast track to all-time highs. It can't be stopped at this point. Junior miners are breaking out of huge bases across the board. We're entering the mania phase, where capital bottlenecks into illiquid microcaps for max torque, in his opinion. I have the same opinion, though. I think silver's going higher, yes. Grain futures AM update. We got Capesize down and Panamax down in dry bulk, 3%, 1%. And then tankers are flat today for VLCC and Suezmax. The commodities to S&P 500 ratio, it remains at historic lows, a setup for the next super cycle. Surely the sluggishness can't last forever. And there we are. This is how low we are. This is very similar to the 1960s. We were down in the 1960s for a good long time, and it looks like we're doing the same thing as the 60s. And then when we turn on up, it's just going to explode like the 1970s. So this is what happened in the 1970s. Big move. From 70 to 73, 74, we had a pullback, and then 80 was the ultimate peak, which is over here. But there was a recession in the middle there. Housing market pulled back in the middle of that bull market in the 70s. Let's stir the X pot a bit. What if I told you that AI was nothing more than another commodity? It looks like AI is moving with commodities, but maybe not. I don't know. What I would say is it's probably just moving with money. And commodities move with money going up. So inflation going up, commodities move with it. We could. It says AI electricity. He's comparing AI to electricity, and electricity is a commodity. It's driven by coal and fossil fuels and stuff like that. But there's the data. That's what it looks like, and these things are all linked up. It looks like we're going higher here from 2020 bottom, and then we've been moving on up. I'm looking for a 3-hump consolidation, 1 hump, 2 hump, and then the third, and then we can break. We may not come all the way down. Sometimes on the third hump, you don't come all the way down. Grady says silver cleared 35 and 37.50 levels as expected. Next big resistance level is at 41.50. A breakout above 48 level could go to 60.70. Been saying for long that silver is climbing the right side of a huge rounded bottom arc, as linked posted below. I'm not going to read all that. So this is silver monthly candles. This is what's been coming on up. That's looking pretty solid there. We'll go back up here. So silver stair-stepped. It's using the pink trend lines, breaking above, then back testing. And the Trump tariff crash in April ended up being just another healthy back test to 28.50. Also said for a long time that one needs to understand that this up move in silver is very different from previous up moves. The chart was now finally ready. That is the difference. Price cannot move big until the chart is ready. During the larger silver sideways consolidations lately, just below 35 plus 37.50 levels, must have been, as usual, preoccupied with listening to attention-seeking narratives about massive impending stock market crash, constant talk about metals manipulation, and the USD going to the moon, instead of looking at price and understanding what is actually happening. Remember, all those who were saying during the last sideways consolidations that silver was about to drop big. Instead, in my silver post 2nd and 5th June, I called the coming breakout above 35 just before it happened. And during the next consolidation below 37.50, I said a breakout above 37.50 was coming. And it came just days later. So silver, yeah, silver's killing it. It's ripping. Probably going to rip much, much higher. URNJ and URNM are just 20 to 30% shy of their all-time highs with spot at 70 and term at 80. The funds flow data shows that there is barely any inflows. What happens when uranium prices hit triple digits? What happens to the underlying holdings when the ETF gets significant inflows? We haven't started the big move yet. It's still ahead of us. We're waiting for those significant money inflows to come. That's when we get liftoff, major liftoff. And yes, we're very far from the bottom of 2020. We just got to keep holding, wait for the big flows to come. They'll come out in the future, just takes patience. And that's when I think we'll get a very big move. You'll also see the juniors rip too. And they haven't really ripped off their bottoms yet. They're still coming off bottoms, some of the really small junior companies. So this is what I called a 1000x chain reaction. I'm getting a stroke. These ratios are like nuclear cascade, blasting from the overinflated stock market straight into metals and onwards to miners, triggering an apocalyptic domino effect with exponential force. Mining stocks are trading at multi-decade bottoms versus the market and are also laughably cheap relative to gold and silver amid a dying dollar and inflation inferno. Silver's even more crushed against gold, with the ratio at ridiculous extremes begging for a reversal. In the end, this avalanche will peak in silver miners. They are also extremely cheap compared to the stock market itself. Juniors and explorers will catapult into the stratosphere. And these are some different ratios showing how low we are, like XAU divided by the S&P 500. You can throw out another trend line through here that we're about to break. This one here is XAU divided by gold. And again, we are at very low levels, and this is one that we watch during the daily market updates. This is a great entry point, in all honesty. This is silver divided by gold, squeezing into a corner here, ready to eventually break higher at some point. Then we've got SPX divided by gold, and we could see a big move lower where gold outperforms the S&P 500. Big bull market's coming. Big bull market. And this rollover top here looks very similar to the rollover top that we had in the 60s to 70 bull market. We had a rollover top here too, kind of a little quicker in the bottom of the market 2000, where gold bottomed. So this is kind of like the big move here. We had a kind of like A, B, C correction. So very similar. Another one from Tim Hack. Commodities are poised for a massive rip higher. The commodity cycle is about to fire off its next leg up. Agreed. Agreed. Looks very good. A whole bunch of different commodity sectors they look absolutely fire. Their pessimism is our opportunity, and that's where you need to buy when sentiment is negative. Change your mind frame, guys. Your mindset needs to change to take advantage of all these people here. The U.S. oil production has now declined on a year-over-year basis for the first time since 2021. And this is oil, not the natural gas liquid crap in there. Decline, baby. So U.S. crude oil production declined on a year-over-year basis for the first time since 2021. Heavy oil is going to be where it's at. Thursday, little thread here about juniors versus seniors. Why should you focus on the junior miners and junior developer stocks instead of the senior mining firms? That's exactly what I do. I have the physical metal, and then I go all the way to the opposite end of the spectrum, and I buy a little bit more in the juniors. I do have some small producers too. So let's go here. Are you willing to do the work, as Rick Rule says? Then junior resource companies are a better option for investors and speculators seeking growth and capital appreciation. If not, close the thread and carry on with your scrolling. Juniors have better reward versus risk. Let me explain. And I do agree with this to some degree. Juniors have far greater upside potential and leverage in a cyclical bull market, while senior miners do not necessarily possess a material advantage in protecting against the downside. Neither should be held throughout a bear market like blue chip stocks. Senior mining firms are not blue chip stocks. Here is some data from within the last secular bull market in precious metals. From 2004 to 2007, GDXJ gained about 300%, while from 2004 to the peak in early 2008, GDX's parent index gained 187%. During the global financial crisis, GDX declined 71%, while GDXJ lost 81%. Then from the 2008 low to 2011 peak, GDXJ surged 578%, while GDX gained 311. So what we're trying to gain here is we get a lot more upside in the junior space, but the downside, GDX or the seniors don't really protect you. So because the risk reward is so much more favorable in the juniors, it's better to be towards the smaller companies and the juniors. And that's basically what I'm doing, is that the asymmetry is so much greater in the junior companies versus the large caps. I tend to stick to the juniors or the smaller producers. And that's where I kind of hang out. I don't like the big ones. The big boys are going to be they're going to be fighting declining reserves. So I like the smaller guys better. Since the late 2022 low, GDX is up 156, GDXJ is up 177. Since February 2024 low, GDX is up 118, GDXJ is up 141. But this is just the beginning. Seniors perform best at the very beginning and then underperform badly the rest of the way. That is where juniors will outperform materially. Completely agree. And you know what? The juniors are still down right now. You have good entry points in some of these companies. The information advantage. It's quite possible for individual and retail investors to gain a significant information advantage in various junior companies. Many small juniors and even medium-sized juniors lack analyst coverage. Retail investors can become experts on these companies. In many cases, you can communicate with the company's CEO. You can become better informed on these companies than most market participants. That is not possible with the senior mining companies. And even if you can reach senior mining companies, how much information can you really gain? They are huge companies with numerous moving parts. Here's a liquidity advantage. Big money cannot buy or sell these companies without having a huge impact on the market. They usually buy in financings. Big money has to be married to them. Ever wonder why Eric Sprott has so many turds amongst some giant winners? You can't trim positions or cut losers until they've lost completely. You can. So potential for significant and sometimes life-changing returns. Unlike the secular bull market in precious metals from 2001 to 2011, the current one, which is just beginning, has the potential to evolve into a bubble and mania, which would entail much higher returns than in the 2000 to 2011 period. I completely agree with him there. We have a different market condition that we are in versus this period here. The bull market has two major similarities to the 1970s. Completely agree. Unlike the 2000s and the 1930s, bonds are now in a secular bear market, as they were in 65 to 82. Also, like the 1970s, Gold and silver will have broken out to new all-time highs early in their new secular bull market. Gold, check, silver perhaps in 2026. The preponderance of new all-time highs in gold and silver over the years ahead will lend itself to more speculation and far more than in 05, 07, and 2010. Think of the junior silver and junior uranium mania in the late 1960s. Think of gold and silver juniors in the 1970s. Listen to Rick Rule discuss the Spokane Stock Exchange and Salt Lake City Stock Exchanges in the 1960s. We're not going to listen to that. Listen to David Morgan discuss the Spokane Stock Exchange in the 1960s. According to HistoryLink, a free online encyclopedia of Washington State history, the average penny stock in the Spokane Stock Exchange appreciated 160-fold in the late 1960s. And you know where we're located? Very close to this, in my opinion. Here's our junior silver stock bull market analog chart. This is an index of 10 junior silver stocks tweaked over the various time periods. It's not necessarily our 10 favorite or 10 best companies. Could this go from the current 400 to 8,000 in 2029? Well, silver is inching towards the greatest breakout in capital markets in the past 52 years. Junior stock bull analogs there. 2020, the big move to 2016, 2008 to 2011's the one there, 04 to 011, or 07, I mean, and then 2000 to 2007, the whole bull market there. So could we get a huge one? Oh yeah, we could. So in summary, juniors are better than larger companies and seniors for investors and speculators willing to do the work. They outperform in a bull market, while seniors and other firms perform almost as terribly in a bear market. Individual investors have an information liquidity advantage in these companies. There's also the potential to make significant and life-changing, maybe even wife-changing returns, as a potential mania is more likely than not. Gold and silver both being at all-time highs soon, the secular bear in bonds, and soon to be secular bear in stocks, which I agree with, will set the stage for an eventual mania in junior gold and silver stocks. Buy value, buy good companies, and manage positions properly. Trim big winners along the way, cut losers and laggards. Thanks for reading. Smash the like button for him. And that's what I'm going to end it on, guys. We're going to end it through there. I don't think there's anything more. Let me look. Yeah, that's it. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.